Hi, everyone. Welcome to the IncomePlus Fund webinar. I'm Michael Episcope, co-CEO of Origin Investments. And this is the IncomePlus Fund webinar. Position for Growth, I believe, is today's title. Let me get to that. Investing for Growth. There it is. I'm here today with my co-CEO, co-founder, and friend, Dave Scherer. Welcome, Dave. We've got a great presentation for you planned today. If you're an existing partner, welcome back. Thank you for tuning in. And if you're a prospective investor, thank you for joining us today. I know we had a lot of interest in this webinar. More than 700 people registered, and we appreciate your time and interest, and hopefully you will be here all the way to the end. We titled the webinar Investing for Growth because we are starting to see early signs of a market recovery. And by no means are we in full recovery, but the worst is behind us. That's what we believe. And it feels like we're kind of exiting winter now and entering spring. And this is when you plant seeds in your investment portfolio and your garden, when the fundamentals are beginning to improve in an asset like multifamily, an asset that has really good long-term prospects. And what we see going on right now in the market is a more normalization. Capital is coming back. Transaction volume has increased and prices are at least stabilizing and going up in some cases. And we still have some room to go. We still have some cleanup of supply, but we see the next couple of years as a far better investing environment for multifamily than certainly the last 2, 3, 4, maybe even 5 years, maybe akin to 2019, where it was more normal. And so we've got a lot of great new information about this fund. I'm going to report out on the fund's performance over the last year. I'll go into a lot of detail, kind of what you can expect as well. And then David is going to talk about a property we sold and a couple of new ground-up development deals we are adding to the fund. And then we're going to open it up for Q&A. We'd like to keep the webinar to around 50 to 55 minutes. Our portion will try to keep under, call it 25 minutes. And so we'll save 25 minutes for Q&A. And thank you, as always, for emailing your questions in advance. We'll get to those. I'm sure many of them you'll get answered during the regular presentation. And if you have more along the way, just be sure to put them in the Q&A and we'll get to them right away. So what you see in front of you is a snapshot of the current portfolio. The NAV sits at around $578 million today, and the largest allocation is the preferred equity, which makes up 57% of the portfolio. And as you know, that's intentional, and that's a debt sleeve, and a big reason for why this fund has outperformed and why it's been so stable over the last few years. And that has come down from the mid 60s over the last, call it several months from last year, early last year. And our goal is to get that down below 40% and probably closer to 30% in the next 18 months. And it's going to happen organically. As these loans get paid off, we're going to redeploy into new ground-up development opportunities and acquire sidecar interests as well. Ground-up development, that makes up the next largest part of the portfolio at around 20%. But I do want to caveat that by saying our ground-up development deals are all in lease-up, so they are well beyond what we call the riskiest stage of development. And at this point, we could actually just put them into the core sleeve, and you'll see them kind of matriculating into that core sleeve over the next quarter. And just as a reminder, 20% is the maximum amount of exposure this fund will have towards ground-up development. And our goal is to always have that sleeve of the portfolio full at that 20% mark, because that's really the jet fuel for the returns here. 15% of the portfolio is made up of core stabilized assets, and 8% of the fund is in cash. And the cash was raised from both an asset that was sold and then a couple of preferred equity deals that got paid off. Dave's going to go over those in a bit more detail. That capital has already been earmarked for new ground-up development deals, and that's going to be deployed over the next few months into 2 deals that we've identified, and we hope to do even more this year. Fund leverage is 53%, fairly conservative, and something we hope to dial up over the next year, maybe closer to 60%, but that really depends on what refinancing opportunity we have available and where interest rates go in the next 6 to 12 months. Lastly, the distribution yield, that stands at right at 6.5%. That's a really healthy yield, especially as short-term rates come down. And we've seen SOFR come down now to about 3.5%. probably will continue to go down based on what's happening at the Fed with inflation. And so I'll go into that, kind of the distribution yield into a couple more slides and break down the yield and kind of the significance of, that yield even further. So here is our 1 year in review. This is the 1 year of returns. This is the breakdown. And the total return was 6.8% over this last year. 6.6% came from the distribution yield, and we had a small change in NAV of around 0.23%. So nearly all the return was captured in the distribution yield. We didn't have much NAV growth, but that shouldn't be a surprise given the headwinds we faced, and that also should turn around in the next year. This next slide, what this shows is return attribution analysis. So it's a deeper dive into the portfolio, what was making up that 6.8% return. And you see the contribution by each sleeve to the fund's total return, the gross, then also the fees, and then getting to the net. So starting at sort of the top left, the common core sleeve, that generated a 6.1% return and comprises 15% of the portfolio. So when you multiply that together, 6.1% times 15%, you get to the contribution of 0.9% to the overall fund's return. And then the development portfolio delivered a 4% return during the year and makes up 20% of the fund. So this added 0.8% to the overall fund's return. But keep in mind that this return is over the last 12 months, and most of the gains in this sleeve were taken in the previous years as construction was being completed. And these properties have generally been in lease up over the last kind of 8 to 12 months, and valuations have been hampered by the amount of supply, the concessions, rent softening in these markets. But this portfolio, we expect it to be a large contributor to future returns as we make new investments in ground up development this year. And lastly, the preferred equity sleeve, that makes up 57% of the fund. It generated an 11.7% total return and contributed 6.7% towards that 8.4%. And this sleeve, it was by far the biggest contributor to the fund's return. And, all the reasons you've seen us outperform. But what works best in a down cycle, being in debt, being protected, not having that unlimited upside, certainly has helped us. But it's not really what it's where we want to be this year or next year, taking advantage of the growth we see ahead. So we are shrinking, intentionally shrinking this part of the portfolio and increasing our exposure to development and core assets. And you'll see that happening slowly. It's already happened. As I said, we took development down from kind of that 65% down to 57%, and that will continue to happen pretty rapidly over the next year as our loans paid off. The fund, it generated a gross return of 8.4%, and then the fees and expenses accounted for 1.6%, getting us to that net return of 6.8%. So this is your kind of full analysis of the breakdown of that of the fund return. What you see in front of you here is our track record, and this is our performance relative to our peer set benchmark. And we really have every major player and index listed here, and we've outperformed them. Now it's over the last 1, 3, and 5 years periods. 3 years ago, when we were reporting out, even 2 years ago, the same information, we weren't leading in every category, in every period. Some funds were beating us over the 1 year, some were beating us over the 3 year, but we were still at the top of the list. Now we're beating every single fund in our peer group that we've been reporting out. And the gains that they saw, especially in 2021, they've really evaporated as real estate experienced a recession. And I think every fund should really be evaluated through full cycle investing, because that's the only way to understand how much risk a manager is taking to achieve each unit of return. And we're incredibly proud of the decisions we've made and how we've managed this fund, and the decisions our team and how we've navigated over the last few years to generate the returns that we have. Now, our bogey is 9 to 11%, and we believe that we're, and in certain years you're going to outperform that, and in other years you're going to underperform that. But over the long run, that's what we expect to return in this fund and expect to generate is kind of that 9 to 11% bogey. This is a deeper dive into the distribution yield. It's sort of a pre-tax and post-tax analysis. So for those of you who are in the fund, you may know a lot of this. For those of you who aren't, this is a really important element. This fund is extremely tax efficient. Last year, the distribution yield was 6.57%, and the post-tax return was 6.53% in this fund. So what the bar on the right shows is the pre-tax equivalent you would have to earn in another investment taxed at ordinary income to achieve that same 6.53%. So when you look at the slippage between 6.57 and 6.53, it's negligible. It's about 98% of distributions came back tax deferred, without any consequence of taxes. And then on the right-hand side of the screen, that's what you would have to earn, and that's only at the federal level, to generate the same after-tax return of 6.53%. When you start layering in state taxes, if you're in California, if you're in Minnesota, New Jersey, New York, you're talking about having to generate 11, even 11.5% to take home that same 6.53%. Tax efficiency is a big part of building wealth, and the after-tax return, it just has to be factored in when comparing and considering investments. So the distribution yield by itself is an incredibly healthy return, and it's a big part of this fund because what you take home is all that matters. So this fund is really about what does it look like in the future for this fund, and how do we break down and how do we get to that 9 to 11%. And what we have here is sort of a range of outcomes by the various sleeves that we have in the fund. And these are highly probable in any given year. And I would categorize these as kind of a, 2 standard deviation return. You're going to have years where we're in a down cycle. We're going to have years when we're in an up cycle. I would say the last 5 years, we've seen greater than 2 standard deviations. We've seen 3 standard deviations, or even more, 4 going through COVID. And so we've actually, we've exceeded the upside in some years, and we've actually exceeded the downside, but this is more of a normal distribution. It's just to provide you with guidance and set expectations, but I'll kind of interpret this starting at the top. Core assets, those should, based on historical averages, return anywhere between 6% and 15%. And if that part of the portfolio, our target is 50%, if it makes up 50% of the fund, you can see the contribution it makes to the fund's overall return profile on the right, 3% to around 7.5% on the high. Debt is going to generate around 11 to 14%. That's going to be really steady, much tighter, narrower band, and the target allocation is around 30%. That creates a lot of stability and consistency in the fund. And I do think this will trend towards the upper end of the range in debt and perhaps even beat it. And the reason is that there isn't a part of the Origin platform that has evolved more than our debt platform over the last few years. We have an entire team on the Origin Credit Advisor side focused on sourcing and managing debt, and those platform enhancements are going to directly benefit this fund. And that team they are overseeing the sleeve of the fund, and we're going to achieve higher returns with lower risk in this sleeve in the future. The last part that you see on the bottom there is development, and we expect our development portfolio to generate anywhere between 8% in bad years, and you've kind of seen that in the last few years. And upwards of 30% or more in good years. So for this, we've sort of bound the upper end by 30%. But for those, but we've also generated north of 40%, even 50% in previous years. We don't believe that's realistic. Those are probably more of those 3 standard deviation returns, but that can happen. Overall, there's going to be some volatility across those returns, but the band is sort of that 6.4% to 14.5%, and that middle range is sort of that 9 to 11%. And it's going to deliver it in a very tax efficient manner. So real estate, it is a cyclical asset, and where we are today is in a trough, but in a trough with improving fundamentals. And just like the great financial crisis and COVID, this too will pass, and we'll be talking about different things in a year and 2 years from now. And we believe the next few years are going to be far better than the last 3 years. I personally, I love the makeup of this fund. I love the strategy. I love the how agile it is, and we're able to adjust it in different environments, the tax efficiency and the outlook. And that's why this fund itself is my single largest holding at Origin that I will continue to contribute to in the future. So Dave, that's it from my part. Hopefully I was nice and succinct there. Over to you.
Thank you, Michael. And I appreciate the introduction. I agree. We're partners and we're friends, and we're 18 years in now. So we've been stress tested, so it's good. I also will be increasing my position in IncomePlus this year significantly. And I'm going to just echo what Michael said. I view the world as a distribution. It's a series of distributions with tails. I think this fund has an upside distribution potential. That doesn't mean it'll happen, but if I look at it, and hold me to this in a year, I think the downside is 6 and the upside is 20. And those are the types of distributions that I like to invest in. So I'll be increasing my own investment here. So I need to cover what Michael was talking about. So but before I jump into Brickyard, let's talk about the capital that was freed up to invest in a Brickyard or to invest in the other development I'll go over in a second, Phoenix. We sold Monroe Aberdeen, and this was strategic. It was part of the move, in this case, not from preferred equity into equity, because Monroe Aberdeen is a stabilized asset in Chicago. So it's an equity investment in its own right. But it was fully valued at NAV. We believe that Chicago will grow, but be a slow grower. And most likely that would sort of settle into that tax efficient 6 to 8% return. That's what we predict out of Monroe Aberdeen. Instead, the asset was sold, and the capital is being redirected. So again, the things that we say, we're showing you that we're doing, right? So we talk about playing offense. This is an example of playing offense. So how do you play offense? Here, we're redirecting that capital into a generational development in Castle Rock with a proven partner, Confluence Development, that is a specialist in public-private partnership with cities into transformational development. And so in this case, Brickyard, for those that are new to this particular development, it's named Brickyard because it used to be a brick factory. And that factory sits about a stone's throw from downtown Castle Rock, which is a super high-end suburb of Denver, fast growing. And so the city wanted to use this, because it's a very large site, as a place to launch a true 24/7 extension of the downtown. And so you're going to have many phases of this redevelopment that we're not involved in, because again, if you're new to this, Origin only does multi. So when you're talking about these large public-private partnerships, we're not going to participate in the sports facility. We're not going to participate in the retail element. So we're participating in the only multifamily element here. It has significant public financing. In other words, we're getting free equity, which augments returns, largely used for infrastructure. And Confluence, we're super excited to partner with them. We go very deep. This is a new partner for us, so we go very deep on diligence with new partners. And one of the things we do is we look at their prior success. Simply to say we've developed a lot of real estate, that's not very relevant to an equity investor. You want to know what the returns were. And I will tell you that we have 2 partners. They're one. The other is NRP. We partner with them a lot. The returns they've been able to achieve through pretty significant real estate development are extraordinary. Confluence's last 5 deals have exceeded 2.5x on equity. And that's really what me and Michael are looking at more than IRR. We want to generate wealth for our partners. So we're really excited about this development, both from a partner standpoint, the public-private partnership standpoint, and it's a true example of us redirecting equity. So this is an equity for equity swap, but it's being redirected from a 6 to 8 into what we believe will be a 15 to 25. I'm going to move on. Same idea. We are reinvesting. We're bound in this fund internally. We have a 20% limit on development. And so we had the ability to enter into new development because a lot of the old developments have been stabilized and are moving into that core phase. So the Ellison is our second that will be in the true development sleeve. Here we're partnering with Stillwater, again, a tier 1 developer and a specialist in the Southwest in Texas. Phoenix is a market we really like, although you do have to pick the correct submarkets. Chandler happens to be one of those correct submarkets, super high end, huge ability to pay, tremendous rent affordability ratios, meaning people make more money than they need to pay rents. So you have the ability to keep rents quite high and raise them. Michael and I and our team have all personally toured the site. It's an amazing site that's directly connected both to the freeways. It's, Phoenix is a driving city, as well as walkable retail, and there'll be additional retail that's being built that's walkable. Again, this is an example of development that, to our margin, we look for developments that exceed a 30 margin. This is a 35 margin. We like it both from the long-term aspect because this is a build to hold. We like the long-term growth of this site. We also like the margin that's developed in the development phase. And that's what you're getting paid for in this portfolio, meaning income plus. Like, this is the type of the portfolio where we should be getting 15 to 25 in a normalized market in the development itself. And then it moves into the core phase. We also wanted to highlight what happens in terms of fund management when deals don't go as you expected. When you look at IncomePlus, essentially it's a holding fund of countless preferred and equity investments, developments, and core assets. And we manage all of them. And as Michael mentioned, we shift strategically. But at the asset level, we wanted to give you an example of an asset that didn't go as we hoped and what we're doing. So Novo Hickory Highlands, this was a preferred equity investment. Again, when we were concerned about valuations in 21, we didn't start new development as much in this fund. And importantly, we didn't buy any assets. No asset was purchased as a core stabilized asset between 2020. February 2020 was the last time we bought a stabilized asset. The next was actually a 1031 investment, which was about a year and a half ago now. So we went about 4 years without doing that. So what do we do instead? We invested in preferred equity. In this case, we entered into this investment between 70 to 85% of the capital structure. But in a preferred equity investment, it also accrues higher into the structure. So in other words, your profit starts accruing from 85 to 86 to 87 to 80. So we sat at about 90 once the development was finished and moving to stabilization. So as we sit today, because it was delayed, because there were construction delays, as well as overages, and it's been a soft market, meaning rents, it's been harder to rent and lease up. Rents are lower than we expected, certainly the developer expected. So we sit today at 100% LTV to our position. So in other words, the asset is only worth the senior debt and the accrued value of our preferred equity position. So as you can imagine, the equity position is completely washed, and they know it. The developer understands that their equity is no longer there. So what do? So the options we're evaluating right now is, one, we can run a formal sale process. Typically, this takes about 60 to 90 days. Here, we'll run a sale process. Senior equity will be paid off. Will be paid off up to the point where that's possible. And then obviously equity, it won't get paid off at all. So that's one option. The other option is to take over the asset. And in taking over the asset, you're essentially taking the position of the developer. They're no longer in control. You own the asset. You're the new equity. And what we need to do in that instance is understand if there's new equity required to further enhance and stabilize the asset. What's the incremental return on that asset? And is it worth it to the fund to put in $1 million, $2 million, $3 million, $4 million to potentially get 15, 20% on that incremental capital? And so, and obviously that takes more time too. And so what's the total value of liquidity? And so we're currently looking at this. I don't have an answer. We'll let you know where credit committee comes down on this. And then of course, we're also looking at the overall liquidity of the fund, the overall strategy of the fund, and how this quite small position, this is only 1.7% of the fund, how it is in relation to these larger questions. But one of the things that we really value at Origin is transparency. And I think if you're an investor, you know that. This particular investment, we stopped accruing. And so our policy is we don't accrue. If an asset is impaired, we don't accrue that return. So what you're seeing in the NAV that Michael showed you is this asset, we haven't accrued for it in over a year. So it's not going, it doesn't hurt the fund to sell it at the current value, but we're trying to see if we can enhance or if we should just free up liquidity. I have a lot of updates on sidecars. And so if you're a new investor, we offer sidecar investments, not always, but occasionally. If a development, for example, is too large for the fund, it's going to exceed that 20%. By doing it, we offer IncomePlus Fund investors an opportunity to co-invest. And this is an example. And so these developments have actually happened and now they're stabilized, and we get lots of questions on what's the timing of this process. In sidecars, historically, you've had the opportunity to either get out with cash, meaning the fund provides you with a cash for your interest, or what we call a 721, or it is the term, a 721 swap. So here you're swapping your sidecar interest for an interest in the fund. What's interesting about that is it's tax deferred. So if you have a profit on the sidecar, you can swap it for an interest in the fund in a tax deferred manner. That's what I do because I think it's much better to invest pre-tax than post-tax. So in terms of the sidecars, IncomePlus will be acquiring Rise Charlotte. I just want to make sure that so Rise, okay, got it. We'll be acquiring Rise Charlotte for cash later this month. So if you were in that investment and you chose not to do the 721, we get lots of questions about that timing. That cash transaction will happen later this month. Rise Bartram Park will be in Q2. That's the cash. So in Q2 of 2026, you'll have the, not the opportunity, but you have to at this point. You'll be provided cash for your interest. IncomePlus will be acquiring the remaining sidecar interests in Reverie Belmont, AKA Morris at Belmont, in Q3 of 2026. Again, that's the cash component. IncomePlus will be acquiring the remaining sidecar interests in Rise Sereno, used to be called Horizon at Sereno, in Q4 of 2026. And then Denton 380 sidecar, a tender offer will be made in Q1 of 2027. And the timing of our tender offers are tied to the value of interest meeting the minimum 1.35 multiple floor. So I hope that answers questions on sidecars. If I didn't, please ask during the Q&A. I think that's my last. Yeah, that's my last slide. So we'll jump right into Q&A. And Michael, please take the first one. Our emails are there as well. That's by design. If you have questions not covered in Q&A, we're going to stop just before 1 Eastern time. Email me or Michael. They're right there. And we'll have us or our team answer.
Hi, Dave. Nice job. 11:30. We got about 25 minutes left. I'll take the first one, and we can knock these out one at a time. The first question, this was emailed in. Will monthly cash distributions come from income generated solely from the real estate invested, or will cash distributions ever depend on future income from investors or future debt? It's a combination of both. Cash is fungible, so we don't earmark this is for this and that's for that. So if we have debt payoff and somebody requests a redemption, then we will pay it out of whatever cash holdings we have. And if we have distributions, then we make that out of the cash holdings as well. So we have assets that generate really good cash yield. And you also have to take into consideration that, we don't, 65% of the people in this fund opt in for the drip. So our cash need on a monthly basis is not as big as you think it is. And really, when you're opting in for the drip, what you're saying is, I don't want assets that cash flow as much. I want a growth-oriented asset. And so we have to, as managers, manage the portfolio around the needs and the desires of investors. And when they vote and they check that box, the drip, then it's our job to figure out where to best invest that capital and build wealth over the long
run. Emailed in question, terrific question. What are the currently the biggest challenges with the fund, and how are you addressing them? This is a very thoughtful question, and my answer will be balancing investment growth with liquidity. This fund is an open-ended fund, and one of the benefits is you as an investor have the ability to get in and out. We need to make sure that's possible. Unlike our competitors, we've never had a liquidity issue. It's mainly because not many people have wanted to get out. But the reality is, the fund manager, we always have to have liquidity to make sure that if you want to get out, you can. But at the same time, you don't want to do that at the expense of long-term growth and returns. And they're not the same thing. Like, if I overweight towards liquidity, it's at the cost sort of the larger return that might be possible in a less liquid option. So I would say that's probably the biggest challenge really in any market environment.
I'm going to jump on to 9. It says the recent explosion of large new apartment complexes over the last 3 years has undermined the rental opportunity and in some cases swamped the market, causing overbuilt lease price erosion. How are you going to prevent this from happening with this fund? So we're still subject to the laws of financial gravity. We can't do anything magical. Our properties can't get $3,000 if the going rent is $2,000. But I would say that when you have an environment like this, it creates an opportunity to invest. And I went over this a little bit in my presentation, but if anybody who's been investing a long period of time understands that when you're in a trough, when you're in a period of recession, when things look the bleakest, this too shall pass, and this will be behind us, and we'll be having a very different narrative in a couple of years. And I can only tell you how we've navigated over the last few years. You've seen that. We've allocated more towards debt, less towards common equity. Now we're going on offense. And you have to believe that in some part of our thesis that the world is going to get better if you're going to invest in this fund, because we're tilting it towards common equity. If you don't believe that, then you should consider the Strategic Credit Fund, which is about to become an interval fund on January 20th. That has much more protection in it, but we're really looking to maximize the upside in this fund while also protecting downside. And I think we've done a very good job of that in the last 3 to 4 years.
Next question, do you feel the reverse immigration under current administration provides any headwinds for this fund? I'm going to assume you mean the interstate movement of population that sort of peaked at COVID in 22 and then reversed during the normalization of the workforce period. I think that's what you mean by reverse immigration. Do you agree, Michael? Because I don't know that relates to the administration, my interpretation.
Yeah, I'm not sure. I would answer it how you
I'll answer that question, and I apologize your question's something else, just email me and we'll do it offline. But I'm going to answer the question: do people normalizing and going back to work and having to move from Austin back to New York, for example, or move from Tampa Bay back to Chicago because they have to be in the office 4 days a week and they didn't used to have to be? We're just not seeing that in the data. The demand and the growth and demand in these Sunbelt cities that we focus in is really high, and it's projected to remain really high. Right now, what we're seeing is the supply that started in 21 and 22 peaked late last year. And to Michael's point, we're starting to be on the other side of that. But this is really a supply issue. It's not a demand issue. So if that's your question, I'm not really concerned about demand and the renormalization of the workforce affecting long-term demand drivers in our markets.
Dave, I'm going to grab 14 and 15. Galen asked the question. I'm interested in the specifics of the Delaware Statutory Trust. DST is beyond the scope of this webinar, Galen, but appreciate your interest. You can email me, Michael, at origininvestments.com. I'll be happy to talk to you or send you to the right person at Origin. And then Craig had a question. Thank you for the consistent performance over the years. We're not comfortable with the new direction of the fund. Can we redeem some or all our investment? Craig, everyone is subject to the redemption policy, so I don't know when you got into the fund, but yes, you're always free to redeem. There's not, I want to be clear here though, this isn't a new direction of the fund in terms of like, I think about that as strategy drift. There's no strategy drift. This is what we've been saying for the last couple of years, but certainly if you're not happy with the returns or the funds or how we've been communicating or anything like that, we don't force people to be in the fund, but you are subject to the redemption policy. So thank you.
I'll take two as well, Michael. Do I think Trump's threats banning institutional ownership of single-family homes will be a boon to multifamily? I don't think that that's going to happen. The banning. So I don't put a lot of weight in that. But I could be wrong, but that's my opinion. If they did ban it, I don't think it affects us so much. It might lead a little bit of capital flow that was going to go into single family homes into purpose-built multifamily. So you're right, it would be a tailwind, but it's certainly not something that I think is investable right now. Very specific question. I'm selling my home for $28 million. Congratulations, by the way. I have about 18 million looking to invest. I want to get 120,000 a month of income. Okay, yeah, that's very simple math. 18 million, our credit fund gets 10% yield, probably a little bit more, but it's very simple math. That would be 1.8 million a year, which actually gets you exactly to your goal of 120,000 a month. So that would be a solution. The nice part about the credit fund is you get 20% reduction on your tax rate. That's a gift from President Trump that's been made permanent. So thank you for that. Go ahead, Michael.
I'll grab two here, Dave, 16 and 17. Theodore asked the question about characterizing the tax characteristics of the fund, income deductions. If you can email me, Theodore, that would be better. This is a little bit more detailed than we're going to go into in the fund, and we can send you the breakdown of all that. But the big answer is that the income that we get, the ordinary income from our debt investments, is shielded by depreciation, and that's how we operate this fund, so tax efficient. Jayan, hopefully I'm pronouncing that right. I apologize if I'm not, Jayan. What's the general duration in years to exit per the investment? This fund is an evergreen fund, meaning you don't have to invest. You can invest for 3 years, 5 years, 20 years, 50 years even. There is a lockup though. So if you do invest in this fund, there's a 1 year lock out completely. You cannot get out. And then there's a redemption schedule that starts at 10% and declines to 0 over the next 5 years. So it's 10, 7.5, 5, 2.5, 0.
Kevin asked a question, are you expecting sidecar opportunities through IncomePlus this year? I'll defer to you on that, Michael.
Kevin, I don't see sidecar opportunities in the Income Plus right now. That could change very quickly. We do have some ground up development deals that Dave went over. There might be a need for that. If we do, of course, we're going to go out to investors. If you want sidecar opportunities, I would say the Select Asset Fund is one of the best funds you can invest in because it has the co-investment opportunity at no fee, no carry. So, ostensibly, if you're investing in that fund, you are going to have 5 co-investment opportunities. It's obviously ground up development. It's a different profile than the Origin Income Plus Fund, but it's still a great opportunity to participate in sidecars and upside in development deals.
Kurt asked a question. Kurt, I'm going to have investment management respond on your question about Bay Meadows. So expect a response from that team.
I'll take 20 and 21, Dave, Joseph, and Rob. How do we find out about these sidecar investments when they can't come up? Joseph, we email our investment partners, and we prioritize any sidecar investments to individual investors. If you do have an interest in these, and it sounds like you do, please email investor relations, or if you have a personal rep at Origin, let them know. They'll put you on the list. They'll make sure that they give you a preview of these deals before they come out. And then Rob asked the question, can you speak about the performance of the sidecars? And I think we went over those a little bit, but Rob, I think a better way to do that, I'm not sure which sidecars you're in today. We do send out pretty comprehensive reports on those. Love to talk to you offline. Just email me or David or whoever your rep is, and we'll set up a time to go over those in more detail.
Mitchell asked a question. It's question 30, Michael. Will we be accepting investments into the credit fund that you previously mentioned? Yes, Mitchell, it's going to be an open-ended fund, and not only that, but an interval fund, which means it's under SEC purview and regulation. It has to have an external board, and it has to provide quarterly, it's required to provide quarterly liquidity. In other words, you can't gate the fund like some of our competitors have in the last few years. So we're super excited about that. The SEC, we're currently in the very last phases because we converted strategic credit into an interval structure. And we're very confident that that should happen this month. I don't want to say a date because the SEC is still in conversations with us, but very, very soon. So reach out to your Origin, whoever you're interfacing with, or email me if you don't have one, and I'll make sure you do.
I'm going to answer Serdar and Karen's question. Serdar, hopefully Dave answered your email. He said, how about the Bay Meadows and Gilbert sidecar timing? If you didn't, email me and I'll get you that. But again, those are, partly it's about meeting that minimum investment return where those assets are performing today, so we can get you an up-to-date answer on that. And then Karen asked the question, is the fund on the Schwab platform? The answer to that is yes. This fund is on all the major platforms: Schwab, Fidelity, Pershing.
Okay. Tripp had a comment on the question reverse immigration, which I think you're right, Tripp, actually. So thank you. Tripp said that it's the current administration removing large numbers of people. So it's the deportation, it's the ICE, it's that. Look, population growth is something that is necessary for multifamily rent growth, right? You need populations to be growing. Importantly, the U.S., we kind of grow at zero, which sounds terrible, but relative to other Western countries, it's pretty good. Most of them are negative. But anytime you're removing population from a country, that's not good for rent growth. I think in our segment of rents, we're sort of the high end, Class A, college educated. We use words like renters by choice, et cetera. We're not really in the population of sort of that Class B, Class C. But if you were in multifamily in those areas and certain regions that are more affected, it probably would be in effect. I also view that as, these are long-term investments. So you kind of have to ask yourself the question, is this the new reality in the U.S.? In 10 years, are we going to have this same reality in 4 years, et cetera? I tend to believe we won't. I think this is, we tend to move extremely to one direction and then we normalize to the other. So these are all questions that you should ask yourself. But if you think this is the new normal, we're going to be anti-immigration and deporting millions of people, that's not good for rent growth, certainly at the low end. So that's a risk.
I'll take Karen and William's question. Karen asked, do you have any seminars planned for Southwest Florida this year? Not currently on the books, Karen, but that could change. I'd love to talk to you about that. Jump on the phone. So if you want to email me, we can set something up, and just love to hear what your thoughts are. William asked, what developments would drive realized returns to the lower end of expected returns? I think he was talking about maybe the slide that I talked about earlier about the lows and highs. William, it's not about a specific development. It's more about vintage. I think it was last month, or maybe this was on the Select Asset Fund. Vintage matters when you invest. And, if you take the vintage from 2013 to 2019 and you separate that out from the vintage of 2020 to 2025, categorically the opposite. The lowest deal we invested in, kind of that 2013 to 19, produced about a 18% return, right, where we had uppers in the 50 percentile. And then going into 2020, you had every headwind against you. You had the collapse of SVB, you had interest rates, you had COVID, you had supply shocks, you had everything during those periods. So it's not about a particular development. It's really about that vintage. And this is also why we feel really good about what's happening today, the normalization of the market, the supply getting taken up. A lot of the things that really eroded value over the last 3 or 4 years are starting to unwind, and we're seeing really green shoots ahead and a healing of the fundamentals in the market. So this is why we think about 26, 27, 28 as a much better vintage than the last 3-4 years, where we've seen nothing but headwinds and rents declining. So hopefully that answers your question.
Question from Rod. How you doing, Rod? Nice to see that you're on. His question was about a DST, actually, Starling, which was one of our first DSTs. He's asking if the fund, because we're going to be acquiring cash interests in other sidecars, if we'll have the cash to acquire Starling at the end of 26, 27. The answer is yes, we will, because that's a strictly 721 transaction. You'll be exchanging your interest for an interest in the fund, and obviously retaining your 1031 status. So unequivocally, the answer is yes, and hope you're doing well, Rod.
We got to, Dave, I feel like we should have a whole nother webinar on sidecars. We got a lot of questions on these.
Yeah, this is what's so awesome for us. We get to hear in real time your questions. And so I think that's a really good idea. We should do that. We should focus where, we're getting a lot of questions on sidecars.
Yeah, clearly. If you do have a question on sidecars, some of this information we don't have at our fingertips right now. We want to get it to you, so email us, or we'll be sure to reach out here. We have your, first and last name. We'll get you the information. Maria, make sure that you keep on, keep all these questions, send them to IR, so that everybody can get their question answered here, and then we'll follow up and have a complete webinar with all the sidecars. We know that a lot of people have money tied up in these sidecars, and there's some moving parts to those as well. So thank you for your questions. We'll get that information back to you right away.
I don't have more questions. Oh, wait a minute. There's 2 more. Paresh has a question. I understand this is not a QOZ. Any color you can provide on new QOZ guidelines that affect this year and impacts on the projected distribution from QOZ 1 and 2. The guidelines won't impact QOZ 1 and 2 because that capital has been invested. The way I interpret what happened with the, how it was included in the tax extension that was just passed, they're making 26, you don't get the 5-year deferral on that new capital. That starts January 1st, 27. But the reason to invest in 26, which I think people are underweighting quite a bit, is they're also going to completely redraw the maps. So you're going to wind up with very, I would say, challenged low income areas only to invest in, which doesn't mean that they can't be profitable, but you're going to have to find local subsidies, i.e. equity from local municipalities, to make those deals work. The AMI, or the average median income requirements, are much more stringent. And then the maps will be redrawn based on a much more recent census. So the deals that we have in QZ 1, 2, and 3 are going to quickly become the far outliers, because these are based on the 2010 census. So in that case, I actually think that QZ 1, 2, and 3 will benefit quite a bit, because we have deals that aren't looking like that. They look at, these are fully gentrified neighborhoods.
All right, Dave, we kept it to the lower end of our timeline here, right around 50 minutes. So I'll let you sign off, but I just want to thank everybody for tuning in. We are super excited about the prospects ahead, and hopefully you enjoyed this. If you have other questions, you can email us. So, Dave?
Oh, thank you very much. Happy to partner with you in this fund, and I'll be increasing. Like I said before, I believe that this will be the year. We're playing between 6 to 16, 6 to 18 in this fund. So hold me to it. We like to be accountable. Have a great day, everyone.
Thank you.